What if I told you that the key to investing success isn't just picking the right stock, but picking the right strategy for you? It's like finding your superpower in the financial world. Forget generic advice. Your investing style should resonate with your deepest instincts, whether you're a calm strategist plotting long-term gains, an adrenaline-fueled explorer chasing innovation, or someone who values the soothing hum of consistent passive income. Join us on an exhilarating journey as we unveil 7 dynamic investing strategies. We'll demystify each approach, expose its true risk profile, and equip you with the knowledge to finally choose the path that feels authentic, powerful, and right for you. We are covering value investing, growth investing, momentum investing, contrarian investing, dividend investing, income investing, and index investing. Want to dive deeper into a particular strategy right now? Skip ahead. You'll find convenient timestamps in the video description to guide your journey. Value investing is all about finding hidden gems. It's the art of buying stocks for less than their intrinsic worth, similar to getting a high-quality item on sale. Think of legendary investors like Warren Buffett, who built his empire on this very principle. Value investors meticulously research companies to identify those with strong fundamentals, like solid earnings, low debt, and good management that the market has temporarily undervalued. This undervaluation might be due to short-term negative news, irrational market fears, or simply a lack of investor attention. The goal is to purchase these stocks when they're on sale, anticipating that the market will eventually recognize their true worth, leading to price appreciation. While value investing focuses on established companies, there's always a risk that the market might not recognize the true value as quickly as anticipated, or that the underlying fundamentals could deteriorate. It requires patience and a belief in the long-term potential of the chosen companies. Ready to explore more ways to grow your wealth? Let's dive into the next strategy. If value investing is about finding hidden gems, then growth investing is about identifying tomorrow's leaders today. This strategy focuses on companies that are expected to grow their earnings, revenue, or market share at a significantly faster rate than the overall market or their industry peers. Think of innovative tech startups, biotech companies developing groundbreaking treatments, or businesses disrupting traditional sectors. Growth investors are less concerned with current valuations and more focused on future potential. They seek out companies with strong competitive advantages. This could be proprietary technology, a unique business model, or a dominant market position. High revenue growth. Even if profits are currently low or non-existent, rapid top-line growth indicates expanding market penetration. Scalable business models. The ability to grow without a proportional increase in costs. Innovation and disruption. Companies that are creating new markets or fundamentally changing existing ones. These companies often reinvest heavily in their own expansion, research and development, or marketing, which can suppress current profits. However, the allure lies in the anticipated massive future returns as these companies mature and capture larger market shares. Growth stocks are inherently more volatile. Their valuations often rely heavily on future projections, making them highly sensitive to market sentiment. Negative news or economic downturns can lead to significant price drops as investors become more risk-averse. Interest rate changes. Higher interest rates can make future earnings less valuable, impacting the valuation of growth companies. Competition and disruption. The fast-paced nature of growth industries means new competitors can emerge quickly, or existing technologies can become obsolete. Failure to meet expectations. If a company fails to hit its aggressive growth targets, its stock price can be severely punished. However, the flip side is that if a growth stock succeeds, the payoff can be substantial, offering returns that far outpace the broader market. This strategy is for investors with a higher risk tolerance and a long-term outlook, willing to ride out market fluctuations for the potential of outsized gains. Curious about other ways to approach the market? Let's keep exploring. If value investing seeks undervalued assets and growth investing eyes future potential, momentum investing is all about riding the wave of current market trends. This strategy involves buying assets, stocks, but also other securities that have shown strong upward price movement and high trading volume, with the expectation that this upward trajectory will continue in the short to medium term. Conversely, momentum investors sell or short assets that are exhibiting strong downward trends. Momentum investors believe that what goes up tends to keep going up for a period, and what goes down tends to keep going down. Their decisions are primarily driven by price action, identifying stocks that have recently outperformed the market or their peers. Volume. High trading volume often accompanies strong price trends, indicating significant investor interest. Technical indicators. Traders use various charts and indicators, like moving averages, relative strength index, RSI, or MACD, to spot trends, entry points, and exit points. This style is particularly popular with active traders who meticulously monitor market data and are prepared to make quick decisions. The goal is to capture profits from ongoing price trends, often exiting positions quickly once the momentum shows signs of slowing or reversing. Momentum investing is characterized by its significant potential for quick gains, but also equally significant potential for sharp losses. The risks include sudden trend reversals. Market sentiment can shift rapidly, causing a stock's upward momentum to evaporate or even turn into a steep decline. If a momentum investor doesn't exit quickly, gains can turn into losses very fast. Whipsaws. These occur when a stock's price moves in one direction, then quickly reverses, trapping traders who entered based on the initial trend. Market volatility. Highly volatile markets can make it difficult to identify and follow consistent trends, leading to more false signals. Reliance on short-term data. This strategy doesn't factor in a company's underlying health, meaning an investor could be buying into a fundamentally weak company simply because its stock is rising. Momentum investing requires discipline, constant monitoring, and a robust risk management strategy, including strict stop-loss orders, to mitigate potential downsides. It's best suited for experienced traders who can react swiftly to market changes. Ready to uncover another distinct approach to the markets? Let's move on. While most investors follow the herd, contrarian investing is about deliberately going against the prevailing market sentiment. It's about being greedy when others are fearful, and fearful when others are greedy. This means buying assets when they are unpopular, beaten down, and everyone else is selling, and selling assets when they are hyped, overvalued, and everyone else is buying. Contrarian investors operate on the belief that markets often overreact, both to good and bad news. This overreaction creates opportunities for those willing to take the opposite stance. Buying into panic. When a sector or individual stock experiences a significant downturn due to widespread negative news, fear, or a crisis, contrarians see potential value where others see only risk. They research extensively to determine if the negative sentiment is truly justified or if the market is overshooting, creating an undervalued opportunity. They look for strong underlying fundamentals that are being ignored due to short-term pessimism. Selling into euphoria. Conversely, when a particular asset or market sector becomes overly popular, driving prices to seemingly irrational highs, contrarians become cautious. They recognize that speculative bubbles often form during periods of extreme optimism and high valuations, and they look to exit their positions or even short the asset before the inevitable correction. You'll need some serious mental toughness and a willingness to do your homework for this one. It means being okay with going against the grain, taking flack, and potentially seeing things get worse before they get better, all while you wait for your big bet to pay off. Contrarian investing is undeniably high risk, primarily because when buying into a declining asset, there's always the risk that the situation could deteriorate further and the market might be right in its pessimism. You could be buying too early, and the price continues to fall, leading to substantial losses. Prolonged underperformance. Being early is often indistinguishable from being wrong for extended periods. A contrarian position might take years to recover or for the market to realize its true value. testing an investor's patience and capital. Being wrong. Despite thorough research, the contrarian's assessment might simply be incorrect, and the asset may never recover or perform as anticipated. Emotional toll. Going against the crowd can be psychologically taxing, especially when faced with continued losses or when popular assets you avoided are soaring. However, when a contrarian bet pays off, the rewards can be significant. Buying low during a period of extreme fear and selling high during a period of irrational exuberance can lead to outsized returns that far surpass market averages. It's a strategy for patient, disciplined investors with a high tolerance for risk and an independent mindset. We've explored some strategies that thrive on bold moves and big risks. Ready to shift gears? Let's dive into an investing approach that's all about generating consistent income and steadily building your wealth over time. For investors prioritizing regular income and a more stable approach, dividend investing is a highly attractive option. This strategy focuses on acquiring shares in companies that consistently distribute a portion of their earnings directly to shareholders in the form of dividends. It's essentially about getting paid for owning a piece of a profitable business. What are dividends? Dividends are a direct payment of a company's profits to its shareholders, typically distributed on a quarterly, semi-annual, or annual basis. They can be paid out as cash. Companies that pay consistent dividends are generally mature, well-established, and financially stable businesses with a history of consistent profitability. They often operate in less volatile sectors and have strong, predictable cash flows, e.g., utility companies, consumer staples, some large-cap industrial companies. Benefits. Passive income stream. Dividends provide a regular, predictable income stream, making this strategy ideal for retirees, those looking to supplement their income, or anyone seeking consistent returns without needing to sell their shares. Inflation hedge. To an extent, while not perfect, rising dividends can help your income keep pace with inflation over time. Stability. Dividend stocks are often less volatile than growth stocks, providing a more stable component to a portfolio during market fluctuations. While generally considered less risky than growth or momentum strategies, dividend investing isn't entirely without its perils. Dividend cuts or suspensions. While dividends are great, they're not guaranteed. Companies can cut or stop payments during downturns, which usually hurts the stock price. Watch out for dividend traps. An unusually high yield can be a red flag, meaning the stock's price crashed due to company problems and that big dividend won't last. Don't just chase high yields. Check the company's fundamentals. Interest rate sensitivity. As interest rates rise, fixed income investments like bonds become more attractive. This can sometimes draw investors away from dividend stocks, putting downward pressure on their prices. Overall, dividend investing is a solid strategy for long-term investors seeking income, stability, and the power of compounding. It requires research into a company's financial health and dividend history, but for many, it forms a reliable cornerstone of their investment portfolio. If dividend investing piqued your interest with its promise of steady payouts, then income investing takes that concept and broadens it even further. Think of it as broadening your net beyond just traditional stock dividends. At its core, income investing is about structuring your portfolio to produce ongoing revenue. It's less about seeing your initial investment grow exponentially and more about creating a consistent flow of money that can help cover your living expenses, supplement your salary, or simply build up your liquid savings. So, what kind of assets are we talking about here? It's a diverse mix. First up, we have bonds. When you buy a bond, you're essentially lending money to a government or a corporation. In return, they promise to pay you regular interest payments. Think of it as rent for your money, and then return your original principal at maturity. They're often considered a cornerstone of income portfolios for their fixed, predictable payments. And yes, our previous friend, dividend-paying stocks, are absolutely a key component of an income investing strategy. We're talking about those mature, stable companies that consistently share their profits with shareholders. Within this, you might explore high-yield stocks, which specifically offer a higher percentage payout relative to their share price. Who is income investing for? Retirees. If you're looking to replace a traditional paycheck in retirement, an income-focused portfolio can provide that much-needed cash flow to cover your expenses. Those seeking financial independence, it's a great way to build up alternative income streams that can eventually reduce your reliance on employment. Diversification seekers. Even if you're growth-oriented, adding income-producing assets can help balance your portfolio, providing a buffer during market downturns. Anyone desiring consistent returns, instead of waiting for capital appreciation, you get money in your pocket regularly. Now, let's talk risk. Income investing is generally considered low to medium risk. It's certainly more stable than aggressive growth or momentum strategies because it often relies on established assets and consistent payments. However, it's crucial to understand the nuances. Your income can change. Companies might reduce dividends, or payouts from other sources can vary. Interest rates matter. If rates go up, your older bonds might lose value. Not all bonds are safe. Junk bonds, for instance, come with a higher chance of not getting paid back. Companies can stumble. Even good companies can hit snags that affect their ability to pay. Income investing isn't about getting rich overnight. It's about building a robust, resilient stream of wealth that can support your financial life year after year. Next, let's dive into an incredibly popular and often recommended strategy, especially for those who prefer a simpler, hands-off approach to building wealth. So far, we've looked at strategies that involve picking specific types of companies or assets. But what if you don't want to spend hours researching individual stocks or analyzing balance sheets? What if you want to invest broadly, simply, and effectively? That's where index fund investing shines. At its core, index fund investing means you're investing in a broad market index. Now, what's an index? Think of it as a predefined basket of securities designed to represent a specific segment of the market. In India, popular examples include the Nifty 50, which tracks the performance of the 50 largest Indian companies across various sectors, or the Sensex, which tracks 30 large companies listed on the BSE. Globally, you might hear about the S&P 500 in the US, which tracks 500 large American companies. When you invest in an index fund or an exchange-traded fund, ETF, that tracks an index, you're not buying shares of a single company. Instead, you're buying a tiny piece of every company within that index, proportionate to its size. Instant diversification. With one single investment, you get instant diversification across numerous companies, industries, and sometimes even geographies. This drastically reduces your single stock risk, the risk that one bad company can sink your entire investment. If one company in the Nifty 50 has a bad quarter, the other 49 companies help smooth out the ride. Hands-off and low-fee. Index funds are passively managed. This means there's no highly paid fund manager trying to beat the market by making active buying and selling decisions. This results in significantly lower fees compared to actively managed mutual funds, where those management fees can eat into your returns over time. Index fund investing is perfect for beginner investors. It's a straightforward way to start without needing deep market knowledge. Long-term investors. It's designed for patience, riding the overall growth of the economy over decades. Set it and forget it investors. Ideal for those who prefer a hands-off approach, contributing regularly and letting time do the heavy lifting. Cost-conscious investors. The low fees mean more of your money stays invested and grows. Risk-wise, index funds are typically low to medium. The upside. Instant diversification means one bad stock won't sink your ship. Broad exposure steadies the ride. The downside, you're not immune to market crashes. If the entire market goes south, your investment will too. Long-term recovery is usually the trend, though. While you won't beat the market with index funds, you also significantly reduce your chances of underperforming it, all while enjoying simplicity and low costs. It's a powerful tool for consistent, long-term wealth accumulation. So there you have it. A comprehensive look at 7 popular investing strategies, ranging from the stable and income-focused to those pursuing high-growth, high-risk opportunities. We've explored value investing, buying strong companies on sale; growth investing, chasing the innovators with rapid expansion; momentum investing, riding the wave of current market trends. Contrarian investing, going against the crowd to find overlooked opportunities. Dividend investing, generating consistent income from company profits. Income investing, diversifying for steady cash flow across multiple asset types. Index fund investing, simple, low-cost diversification for long-term market returns. Each strategy has its unique approach to the market, its own set of risks, and its own potential rewards. The best one isn't universal. It's the one that aligns with your personal financial goals, your time horizon, and your comfort level with risk. Now that you're armed with this knowledge, we want to hear from you. Which strategy fits your goals and risk tolerance? Want to master the art of stock selection for any of these approaches? Tell us in the comments. Your feedback helps us create the videos you need to invest smarter.